Welcome to edition 12 of the NCUA video network, entitled Share Insurance, A Better Way. Recently, the bill to capitalize the NCUA Share Insurance Fund was signed into law by the President. In this special edition of the NCUA video network, we'll take a close look at that legislation and the operational procedures approved by the NCUA Board at this month's meeting.
The staff recommends that the board adopt the plan as summarized by Bob Fenner based upon these financial conditions.
Well, thank you, gentlemen. That's a fine presentation. Now, to facilitate this discussion, I would move that the board accept the staff recommendation.
I'll second that motion. And Mr. Chairman, I am ready to support this and think it's an outstanding product as a partnership among government and credit unions.
All in favor signify by saying aye.
Aye.
Ayes have it. I want to congratulate every member of the team. I think this is a very significant thing for credit unions. I'm delighted at the hard work of everyone. I think the real challenge goes to you people at NCUA now. This system can work beautifully for credit unions in the future, and just as PA has said, the real secret now is the operation.
And now NCUA Board Chairman Edgar F. Callahan.
The instructional film you're about to see has to do with the capitalization of the Share Insurance Fund. It's entitled A Better Way. For this past year, all of the credit union world has been debating a better way to finance their safety net, or the Federal Share Insurance Fund. We're happy to report that it's a great victory for all credit unions in that we now have a safety net that's truly unique and one that sets credit unions apart from all other financial institutions. Before we get to the mechanics of how your new share insurance program will be funded, let me take this opportunity to thank each and every one of you for your contribution to this grand success for credit unions. All of the people at this agency, the examiners and the staff, the trade associations, but in particular, the loyal support from all of those credit union managers and boards that wrote their congressmen and worked so hard to achieve this victory needs to be noted at this time. I sincerely thank you. It is a better way for all of us, and the future will prove that credit unions are still unique. Thank you.
This tape contains 3 sections, each one looking at a different aspect of what this plan means and how it will affect credit unions. First, an NCUA examiner will discuss the forms and procedures through which you will pay your share of the capitalization. Then Chip Filson, Director of the Office of Programs, will take a look at the history behind the capitalization plan. And thirdly, managers from 2 credit unions will discuss some of the questions on their minds. And now Pam Bacher, an examiner from Region 2, will discuss the examiner's role in the capitalization process.
In early December, each examiner will receive a package which will include the following items for distribution to each credit union in the examiner's district. 1, a financial and statistical core report for the year ending December 31, 1984, more commonly known to examiners as the 5300. 2, a copy of the recently updated booklet, Your Insured Funds. And 3, a share insurance fee statement. For federal credit unions, the share insurance and operating fee statement will be combined on one form. One aspect of the capitalization legislation is that each credit union's 1% deposit and annual insurance premium are now based on just insured shares rather than total shares, as has been the case in the past. The 5300 form, which will be included in the December package, has been revised to reflect this by adding an NCUA insured savings computation. This computation, along with the booklet Your Insured Funds, will assist the credit union in determining the total amount of its insured shares. Once this amount is determined on the 5300, it will be used in the calculation of the credit union's deposit and insurance premium on the share insurance fee statement. The 1985 share insurance fee statement is broken down into 3 parts. Not coincidentally, these parts coincide with 3 major actions taken by the NCUA board. The first part addresses the 1% deposit, which the board has decided to fund in full in January 1985. The second part deals with the annual share insurance premium. The capitalization legislation still provides for an annual premium of 1/12 of 1% of insured shares. However, because of the interest income that will be earned from the immediate funding of the 1% deposit, the NCUA board was able to waive the 1985 premium. The third and final part of the share insurance statement pertains to an earnings credit on fund equity. Basically, this is a distribution of excess equity. Legislation sets the fund's normal operating level at 1.3%. This is the ratio of fund equity to total insured shares. Any excess must be distributed to insured credit unions. Full funding of the 1% deposit in January 1985 will increase the ratio above the 1.3 limit by approximately $86.5 million. This excess equity will be distributed to each insured credit union on a pro rata basis. The distribution to each credit union will equal approximately 136% of the premium that it paid in 1984 on its December 31, 1983 share balances. For example, if it paid a premium of $100, it will receive a credit of $136. Now let's go through a sample calculation for ABC Credit Union. Assume that ABC Credit Union has total insured shares of $1 million on December 31, 1984, and that it reported and paid premiums on $900,000 in shares on December 31, 1983. In the deposit section on line 1 of the statement, the credit union will enter total insured shares. Remember that this amount will have already been calculated on the 5,300. For ABC Credit Union, insured shares total $1 million. The credit union will then multiply this amount by 1%. In this case, the result would be $10,000. Line 2 reflects the prior year's deposit. Since the credit union is now making its initial deposit, this line will show a 0 in 1985. The line will be used in future years to adjust the credit union's 1% deposit level. Line 3 is the deposit amount due, in this case $10,000. In the premium section on line 4, the credit union will again enter total insured shares of $1 million. As instructed, it will then multiply this amount by 0.0008333, or 1/12 of 1%. The result is a premium of $833. Line 5 will reflect any waiver of premiums. Since the NCUA board has waived all of the 1985 premiums, the credit union will enter the full $833. Line 6 is the net premium due. Obviously, for 1985, this will be 0. The earnings credit section starts on line 7. The amount of prior year's insured shares and the earnings credit will be pre-printed on the form prior to being distributed to the examiners. In ABC Credit Union's case, it will show insured accounts of $900,000 and a credit of approximately $1,020. The $1,020 equals 136% of the $750 premium paid by the credit union in 1984. Line 8 represents the net funds due to the share insurance fund for 1985. This is calculated by adding the deposit amount due, which is line 3, and the premium amount due, which is line 6, and subtracting the earnings credit on line 7. The net amount due for ABC Credit Union is $8,980. The accounting entry for this transaction will be entered on each credit union's books in 1985. For ABC Credit Union, the entry will be as follows. Debit account 794 entitled Deposit in NCUSIF for $10,000. This is the amount found on line 1 of the share insurance fee statement, which represents the credit union's 1% deposit. Credit cash account 731 for $8,980. This is the amount found on line 8 of the share insurance fee statement, which represents the credit union's actual cash payment to the fund. Finally, the credit union, at its option, will credit either account 931 regular reserve or 940 undivided earnings for $1,020. This is the earnings credit found on line 7 of the share insurance fee statement. As shown in the accounting entries, the deposit will be carried as an asset. It's considered an asset because the deposit is returnable under certain conditions, and it is expected that the deposit will earn an annual dividend. As an examiner, you've seen similar accounting treatment of such items as deposits or reserves that a credit union is required to maintain to participate in certain lending or insurance programs. Another point demonstrated by the accounting entries is that there will be no share insurance expense in 1985. I know that many credit unions included a double assessment when preparing the 1984 budget just in case. To credit unions experiencing profitability problems, this was a major expense item. I'm sure the removal of the possibility of a double expense, let alone no expense in 1985, will be a welcome relief. Returning to the discussion of the share insurance fee statement, as done in the past, examiners will mail statements and verify the accuracy of data submitted by the credit unions. Specific written instructions will be provided to the examiners in the December package. The share insurance fee statement will also include a toll-free number for the applicable regional office in the event that questions arise. Finally, examiners will be able to raise questions on the capitalization issue at the examiners' conference in December.
Chip Filson, the Director of the Office of Programs, is here to give us some of the history behind this capitalization plan and to review the importance of this legislation for the entire credit union community.
The implementation of the capitalization plan approved by the NCUA board in October is the third major effort to capitalize NCUA's insurance fund. This deposit approach evolved out of the fund's previous financial history and reflects the lessons that we have learned in the fund's first 14 years. In 1970, NCUA's insurance fund was established with no capital. From 1971 to 1978, as you can see on the enclosed graph, fund equity rose at a much faster rate than the growth of insured shares. The top line of the graph shows that fund equity was increasing throughout all of this period through 1979 at a much faster rate of growth than the insured shares rate. Almost all income during the fund's first 9 years were from the annual premiums paid by credit unions of 1/12 of 1%. Overall, an average of 74% of total revenue during this period went into building reserves. The result of this, as you can see on the second graph, shows that the fund equity to insured shares grew continuously and peaked at 0.32% in 1979. Now, there are three general reasons for the success of the fund during these initial building years. First, the fund was able to qualify all credit unions prior to underwriting the insurance. Secondly, the self-help tradition that was developed during the 36 years of federal credit unions in which they were not covered with insurance continued in the early years of NCUA insurance availability. This self-help tradition is typified by league stabilization funds and the willingness of boards and members to be tolerant of lower than market dividend rates when that was necessary to reestablish the financial condition of problem credit unions. And finally, national economic trends were generally very positive during these building years of the fund's initial establishment. In the next 4 years, a period that we call an era of challenge, all of these favorable factors began to erode. Another significant impact on the fund and on credit unions was the beginning of deregulation in 1978. Credit unions began to lose the comparative advantages they had had in paying dividends that were slightly above those permitted other financial institutions that were limited by Regulation Q. And also the money market mutual funds began to impact and to attract the savings of individuals. The result, as can be seen on the third graph, is that credit unions began to experience increasing losses, and subsequent credit union failures increased dramatically from the period 1979 through 1981. And as these credit union failures increased, the expenses of the fund to cover these failures also increased. As you can see on the next graph, the bottom line, or fund losses rose dramatically from 1979 and peaked in 1982 and was still at historically high levels even in 1983 and continuing on into 1984. This squeeze that these increasing losses put on the fund's revenue meant that the earlier graph that we showed of fund equity to insured shares not only did not continue to grow, but actually fell during this period of time. As a result of that falling trend or declining trend in the fund's equity to insured shares, the board in 1982 elected to use the only option provided by the statute. That was to assess a second premium. As can be seen on the next graph, two special premiums were assessed in 1982 and 1983. And in 1982, almost all of that second premium went into absorbing the losses and expenses of the fund in that year. The top segment of that bar is the only amount that went into fund equity. While in 1983, all of the second premium went into building fund equity, the net result was still that at the end of the fiscal year, 1983, fund equity still had not reached the peak it had in 1979, and it stood at only 0.29%. Moreover, after the second year in which the cost of federal insurance to credit unions had effectively doubled, credit unions began to ask the question, is there a better way of trying to build our fund and reach the 1% goal established in the statute? Because of the action the board took at its October meeting, there now is a better way. Through immediate capitalization in January of '85 by all credit unions, the fund is able to predict its income from investments with sufficient accuracy to entirely waive the premium for 1985. Therefore, credit unions will have no insurance premium expense in 1985. In addition, our forecasts show that the fund should be able to pay a dividend on the deposits that are put into the fund in January at the close of the fund's fiscal year in September of 1985. The result of these two actions, the waiving of the premium and the dividend, means that credit unions will have a yield in excess of 14% on the deposit that they place with the fund in January of 1985. This yield is composed of two parts: the premium expense that they no longer have, and that premium expense exceeds over 10% because, in fact, the credit unions will not have to forward the entire 1%, but will receive a credit for fund equity that is distributed in the statement that Pam Bachler has previously explained to you. And the second part of that return is the dividend that we forecast will be paid in September or October of 1985. But in addition to this return to credit unions, the fund itself will become the strongest of the three federal insurance funds. As you can see on the enclosed graph, the fund's ratio of equity to insured savings is significantly greater in 1985 than either the FDIC or FSLIC. Instead of being the weakest of the three federal funds, the fund is now the strongest. And by being the strongest, credit unions have taken a significant step not only to preserve the safety net for all credit unions, but to keep the integrity of NCUA and their own insurance fund for the future. This plan is indeed a better way for credit unions, their members, and of course the NCUA.
Andy Walsh is president and David Barrett is the manager of the Bulldog Federal Credit Union, a $15 million credit union located in Hagerstown, Maryland. They are here with us to discuss some of their questions about the capitalization plan.
Dave, Congress recently passed the law on the capitalization of the share insurance fund. What does that mean to our credit union and to other credit unions?
Well, our credit union and any other credit union, it basically means that the share insurance premiums that we've been paying in the past are no longer going to be required. 85's been waived, and as far as I understand, they're going to be waived on a permanent basis. So it'll turn an expense that we've had in the past into an asset in the requirement of a 1% deposit of insurable shares that we will carry on our books as an asset versus the expense that we have been incurring in the past.
Does this present a problem to us as far as liquidity, the need to deposit the 1% in January of 1985?
Well, if they said we had to do it tomorrow, there wouldn't be any problem. Currently, we're 81% on a loan-to-share ratio, so our liquidity's somewhat loose. But in January of 85, it's hard to say where we'll be. But what you have to do is NCUA's giving you 3 months' notice. You're going to have to be able to react to their legislation and say, well, I have to plan for that 1% deposit in January, where we've taken CDs that we have maturing in January of 85 for that reason, to be able to make the 1% deposit.
The 1% deposit that credit unions will forward to NCUA, what does NCUA plan to do with those funds?
Well, due to a regulation of law, they're required to be able only to be able to invest those in Treasury securities. The term or the maturities of they can only go up to a 2-year maturity, so they can only invest in Treasury securities with those type of maturities.
The 1% of insured shares that we will send to NCUA in January, where will we carry it on our financial statement, and what does it mean to our financial statement? And will it produce income or earnings?
Well, the 1% deposit is based on your insurable shares, so we would have to calculate December 31st of 1984 what our insurable shares are, take 1% of that, and have to deposit it with NCUA. In turn, we will carry that as an asset on the books. As I said before, it would no longer have to run an expense item through the income and expense statement with the share insurance premium, but instead you'll see an asset showing up on the balance sheet that is the 1% deposit.
I understand that NCUA estimates that with the fund properly managed, that they feel, barring any disastrous economic times, that the insurance premium for all intent will be waived. Have you heard anything about that?
That's what I understand, that with the capitalization meeting the 1.3% of equity to insurable total credit union insurable shares, that with the earnings they make on their Treasury securities throughout the year, they don't see a need for any more assessments of share insurance premiums. In fact, they even project a dividend on a return of the 1% deposit. So the asset we have carrying on our books could in fact be a earning asset. We would be able to yield some money in effect of a dividend that the board, NCUA board would declare at the end of every fiscal year.
So the bottom line for our credit union is, as far as our income and expense statement, we lose an expense, we make an investment that has income, and we capitalize the share insurance fund, which is for the safety and security of our members' funds.
There are many other questions in the minds of credit union managers and officials about the capitalization plan. Richard Dennis, manager of the Printers and Engravers Federal Credit Union in Washington, D.C., is here with Pam Bacher to discuss some of these questions.
Pam, I have a couple questions for you concerning the capitalization fund. We have to put in 1% of our insured shares into the fund, but I don't have to send you a check for the full amount, so I understand. What happens? What's going on?
Okay. The check that you send to us will be the difference between your 1% deposit less the equity distribution. What we're doing is simply eliminating an extra step. Rather than you sending us a check for the 1% and us sending you a check for the equity distribution, we're asking that the credit union net these two amounts and send us a check for the difference.
On the accounting entries, what do I do with the difference that I don't send to you on my books?
Okay, the offsetting credit will be to an account of your choice. That will be either the regular reserve or the undivided earnings account.
Now, with the asset account, an asset account usually is an income earning account. Can I accrue dividends on this income earning account on a monthly basis?
At this point, it's too early to tell what the board will be declaring in a dividend in November of 1985. So we would not think it proper at this time to accrue dividends. Perhaps a few years down the road, we'll have a better idea of the actual rate of the annual dividend, so a credit union could accrue dividends in the future. And we don't think, because the deposit, 1% deposit, is a small amount, we don't think failure to accrue income will be distorting to the credit union's income statement.
The plan to fully capitalize your share insurance fund is now in place. In a few short weeks, federally insured credit unions will join together to make the NCUSIF one of the strongest and safest share insurance funds in the world. As Chairman Callahan stated earlier, every member of the credit union community played a part in having this important piece of legislation become a reality. It's something we can all be proud of.